Riley Natural Fertilizer Company, a publicly traded company, must acquire 400 acres of land to meet its immediate growing demand for its products. It intends to borrow $10 million from its primary lender, First National Bank. What would be the advantage of borrowing the funds to pay them back in 350 days versus borrowing them under an agreement to pay them back in, say, 1,825 days? And then also explain how borrowing the funds will change its financial statements if it borrows the funds under the 350-day agreement versus the 1825-day agreement. Okay, so let's take a look at what the advantages and disadvantages would be under the two different options. Okay, so let's start off with the advantages of a 350-day loan. Okay, first, there would be lower interest expense. Okay, short-term loans typically have lower interest rates compared to longer-term loans, and so that could potentially reduce the company's overall borrowing cost. Now, let's talk about flexibility next. The company could quickly repay the debt and reevaluate financing needs sooner, so it has a bit more flexibility with the 350-day loan versus the longer loan. How about the balance sheet impact? The loan is classified, or the loan would be classified as a current liability since it's due within a year, which may affect liquidity ratios, and in particular, the current ratio. Okay, so that's the balance sheet impact, right? The current ratio is going to show greater debt since the current ratio is current assets divided by the current liabilities. That will drive down the current liability, the current ratio, I mean. Okay? Now, something you may not consider as an advantage is that you may have less restrictive covenants. Okay, short-term loans often have fewer financial covenants compared to long-term loans. And a covenant just means extra requirements that the lender puts into the financing agreement. An example might be that you have to maintain a certain current ratio or certain profitability or interest coverage ratio. Okay, lenders like to put that in because they want to make sure they're going to get paid back if the company runs into trouble. Okay, now let's look at the advantages of a 1,825-day loan. Okay, first, we consider that we're creating stable financing. All right, this provides long-term capital, right? 5 years greater than 1 year for land acquisition without the pressure of meeting or of having a short-term payment. Okay, so that's an advantage of the long-term, one advantage of taking the longer 5-year loan. Now, it also has a lower short-term cash flow burden. Okay, this means that the payments are spread over 5 years. The company has more time to generate revenue to support repayment. Now, this assumes that we're paying the loan back over 5 years, like a certain amount to be paid over 5 years, but that's not indicated here. It could be that we get to borrow the money and we don't have to pay it all back for 5 years. But of course, that gives us 5 years to build up a cash reserve that we could use to pay it back, right? So there's an advantage there. Lower short-term cash flow burden. All right, let's take a look at the balance sheet impact here. The balance sheet impact here, and by the way, the balance sheet impact is not necessarily an advantage or a disadvantage. We're just looking at it. This loan would be classified as a long-term liability. Now, that would potentially improve the liquidity ratios, right? Because up here we're talking with the 350-day loan, we're impacting liquidity ratios, which are ratios that are really concerned with the company meeting its short-term obligations, right? Like the acid test ratio or the current ratio, okay? But in the advantage of the longer loan, it's a long-term liability, so the liquidity ratios are not harmed. It keeps short-term debt off. In other words, the short-term debt is not impacted. All right, now let's specifically focus on the financial statement impact of the 350-day loan. Okay, first, on the balance sheet, what we have is a current liability. It would most likely be called short-term debt, loan outstanding, something like that. Okay, on the income statement, we would have interest expense recorded during the year. On the cash flow statement, we would have cash outflows from financing activities. When the loan is obtained, okay, you're going to get cash outflows. I need to spell that correctly. Appearing from financing activities when the loan is obtained. And why don't we just say, and principal payments, again, a financing activity, when it is paid back. Okay? Okay, now let's look at the financial statement impact of the longer term, the 5-year or 1,825-day loan. Okay, look at the same areas. On the balance sheet, it's going to be recorded as a long-term liability, right? Won't be paid back for greater than a year, so it's going to show up under long-term. Now, there will be a portion due within the year as we prepare financial statements, right? You have to take that portion that will be paid back within a year and show that as a current liability, as the current portion of long-term debt. But initially, it's all going to show up as long-term liability. Okay. Now, if that full loan isn't paid back entirely until the 5th year, we will not see a reclassification until we produce financial statements at the end of the 4th year, because now it would all be due within the next year, which would move it to a short-term obligation when we prepare the 4th year's financial statements. Okay, let's take a look at the income statement. We would have interest expense shown over many years. With the 350-day loan, we're only going to have interest expense in the next 350 days. After that, it goes away because the loan would be paid back. But here we're going to have an income statement impact over many years. Now, in terms of the cash flow statement, what are we going to see? You're going to have oh, by the way, this up here, this says cash outflows. That should be cash inflows. Correct that. Cash inflows when the loan is obtained. And then principal repayment when it's paid back. So it's a cash outflow when it's paid back. I wanted to correct my earlier misstatement here. But on the cash flow statement, you're going to have an initial cash flow, under financing activities. Okay, that's when the loan is obtained. So no difference there. And you're going to see principal repayment when it is paid back, a cash outflows. Again, that would appear under financing activities on the cash flow statement. Okay, so you might ask, well, which is the best choice? Well, it depends. If the company needs financial stability and lower cash flow pressure, maybe the long-term loan is the best option. But if it seeks lower total interest payments and quicker flexibility, then the short-term loan could be the better option.